My name is Derryn Maade, and thanks, Amy, for the introduction. As Amy mentioned, I'm the Global Head of Metals and Mining Markets at Mackenzie. It's really a pleasure to be with you here today to have a bit of a conversation, and I'm more than happy to make this as interactive as you'd like along the way. So please do feel free to ask questions if you have one as we go along. I'd like to start by just saying that the world is changing. And some changes that we've seen have been for the better. The emergence of the energy transition as really a global concern, despite coming out through a period of the pandemic. So really there is a bit of a silver lining to the past couple of years that we've all experienced. Some of these changes have, however, been for the worse. And I don't think many of us would have ever thought that during our lifetimes we would have seen the re-emergence of cross-border wars taking place. And so the impact that that's having on sentiment globally is really profound. And some changes have been really an unwinding of past excesses that we've seen. And there we've seen a global response from central banks all over, raising rates. And the era of cheap money has really come to an end as a result. So against this backdrop, I'd like to take you on a journey to explore the supply and demand for metals and mining on the road to net zero. There we go. To start with, I think it's worth reflecting back to COP26 in Glasgow last year, where we saw a number of changes take place in terms of net zero pledges. So I'm pleased to let you all know that those now cover 88% of global CO2 emissions. But when you take a look at these pledges in a little bit more detail, there's a few things that stand out, and some of which are quite concerning. So if you take a look, only 16% of these pledges are currently legislated. The remaining 72% and a combined 13% really are proposed in policy documents or are under discussion and have no targets. When you take a look as well at the target date for these pledges, you'll see that less than half of those are actually covering a period that looks to target this reduction in emissions on pathway to net zero by 2050 or sooner. So the world has really made some good progress along these lines, but there's clearly a lot more that needs to be done in terms of actually certifying these pledges. I just wanted to introduce Wood Mackenzie's framework for how we think about the road to net zero. We call it our Accelerated Energy Transition, or AET 1.5 degree case. It's really a case that aligns with the ultimate goals of the Paris Climate Agreement. And so you can see here on this slide, we are seeing the white line on the left-hand side there is our accelerated case. It sees a rapid decline in carbon emissions. And it compares against the base case there in the blue line, which we call our energy transition outlook. And so the transition outlook is really a scenario that's consistent with a 2.5 to a 2.7 degree warming globally. It looks at current policies and existing technologies, as well as some nascent technologies emerging. Whereas the accelerated case, as I mentioned, really is consistent with a 1.5 degree warming scenario. And it's fully aligned with the ultimate goals, the most aggressive policies that have come out through the Paris Climate Agreement. That's all good and well, but how do we get there is the important question. And when you take a look at what needs to take place, well, really it's in reality a multitude of things that need to come together, all pulled together to enable this transition to accelerate. So if you have a look at CO2 emissions that need to drop substantially to 2050, it's a combination of different sectors. The power sector, buildings, industry, transport, and technology all need a unified commitment to this transition, as well as carbon abatement. Key areas of growth you can see on the right-hand side here. So electrification, renewable energy, bioenergy, nuclear, are all complemented then with the likes of huge gains in energy efficiency, the emergence of green hydrogen, carbon capture and storage, as well as nature-based solutions, all combining to achieve what needs to happen in an accelerated transition or the road to net zero. all of these things need to happen different sectors of the economy need to work together to enable this to take place. So if we take a look at some of the sectors that are needed to build our decarbonized future, I'd like to highlight a few of them that we mentioned here. So if you take a look at power generation, the big change between our base case and the accelerated case is that fossil fuels fall, of course. Renewable energy, wind and solar grows rapidly through this process. The big change that's worthwhile highlighting in terms of metals demand is, of course, in road transportation, and that's a rapid transformation. Internal combustion engine vehicles are due to fall, and of course EVs and fuel cells have to grow quite rapidly out to 2050 in order to bring about the reduction in carbon emissions that we need from this sector. There's obviously a corresponding impact to infrastructure as that gets built out to support these new technologies and consumers' adoption of them. And that also has a consequential impact on the positive side for metals demand that we'll get into during the course of this presentation. Worth highlighting green hydrogen being deployed at scale through this process and carbon removal technologies that become mainstream. So many of these, I'd highlight again, really represent a step change in metal-intensive demand that I'll get into now. So taking a look at EVs in a little bit more detail. So there's significantly higher penetration that we're assuming in our accelerated case versus our base case. And to Michael's earlier question, it does imply a significant uplift in terms of where the supply gaps are and where our demand forecasts are for the likes of battery materials, lithium and nickel, copper in particular. The transport revolution that we're seeing in this slide is really the biggest driver of metals demand over the next 30 years. And it's important to see that cell chemistry is also evolving over this time as well. So the panel mentioned earlier, current technologies, NCM, and how those are going to evolve. Well, we see those evolving to greater use of nickel to high nickel battery types over time and through this accelerated transition. All of this change relies squarely on the availability of metals. And you can see from this chart that really we have a huge impact implied for base metals from 2020 out to 2050 under an accelerated case. So the impacts on copper, aluminium and nickel is shown here. And I'd really like to highlight that this massive demand growth is really brought about by a handful of sectors under the energy transition. Of course, copper and aluminium, as good conductors of electricity, have a strong role to play in the build-out of the grid. You'll see that EVs are a consistent source of demand across all three of these. And then the likes of energy storage systems, solar and wind all make up the balance. But if you actually take a look at the numbers from the bottom of the chart to the top of the chart, that progression implies a doubling of demand for copper to 2050. It implies a near doubling for aluminium, and it implies a threefold increase for nickel over this period. So certainly a big challenge when you think about it from the industry's perspective of how do we actually get to supplying this kind of demand outlook. Just touching on battery materials as well, and Michael, again, to your point on lithium, well, you'll be pleased to see that we're assuming a 9-fold increase in lithium demand in our accelerated energy transition case from current levels. That's obviously driven by largely the automotive sector, as expected through batteries. And then taking a little look at cobalt, it's a bit more nuanced because what you've got is you've got battery superalloys and magnets, which are leading most of the demand growth there. But then you've also got an offset from cobalt's use as a catalyst in industrial processes. And that's mainly in hydrocarbon chemistry, and we expect that sector undergoes rapid decarbonization through this accelerated transition. And so there's an offset to our forecast for cobalt demand. So the flip side of this is, of course, what happens to bulk commodities through an accelerated transition. And it's obviously an important part, given that they are, as Michael highlighted, huge emitters of CO2 on a global basis. So it's an important part of meeting our accelerated energy transition goals. The demand story for bulk commodities through an accelerated pathway is really a course of decarbonization and not outsized demand growth. So as you can see from the slide, steel emissions need to decline by 93% out to 2050. And you can also see that steel represents 7% roughly in terms of global emissions. So you're looking at about 6% of global emissions that's due to come out if we're successful through this transition. That's obviously a huge positive impact on the planet. But when you take a look at the steel industry, you think, well, it's a massive challenge. You're talking about $1.3 trillion in terms of investment that needs to take place to enable this transition. And the important question is really to think, well, how do we get there? How does the steel industry undergo its decarbonization? And this slide, it's worth highlighting, well, firstly, the challenges that steel output on a global basis is growing. It's growing stably and slowly out to 2050 by about 0.5%. But that implies that there's pressure on emissions as the sector still continues to grow over this time. As I mentioned, emissions need to fall 93% to enable this. And that comes back then, of course, to the steelmaking route and steelmaking technologies. So you'll see under our base case that we're assuming roughly a 50-50 split between the blast furnace BOF route and the electric arc furnace route. Blast furnace BOF route being significantly high in terms of its emissions output, EAF significantly low in terms of its emissions profile. And that needs to obviously change then markedly as we move under an accelerated case in favor of EAF production, and we see a huge reduction in the BOF production as a result. So that mix changes from 50-50 to roughly 73-22, and then you've got a balance of emergence of new and nascent technologies such as molten oxide electrolysis coming forth to fill the gap. That picture obviously has a profound impact on associated industries. And so when you look at the metallic side of it, scrap collection is going to remain challenging through this process. So we see sort of modest growth in scrap in accelerated versus our base case. The big changes really come in terms of DRI, which you can see it's really doubling from our base case at 2050. And in terms of hot metal production, so obviously from the blast furnace BOF route, that falls substantially over this accelerated transition. And that obviously has implications for iron ore industry, where the industry needs significantly higher volumes of DRI, but less iron ore overall. And so there's going to be a focus on what is the quality of your feed material, and high quality iron ore is obviously going to be favored over low quality iron ore in this transition. It also then has structural implications for various players within that industry. You look at the likes of your high grade producers, largely from Brazil, and sort of average grade sitting in Australia, but also some low grade producers sitting elsewhere in Australia and the rest of the world. So the other changes in the met coal industry, and as the blast furnace route really falls off under this transition, you need to see met coal demand being falling by at least 60% over that same time. So a huge structural headwind to that industry. And then it's worth talking about as well the sources of power that was mentioned on the panel as well. Thermal coal in power production into the sector needs to fall by at least 69% to enable this accelerated transition to take place. Moving on to the supply side of the equation, and this is where things get really interesting. So this chart is showing our supply gaps that we're envisaging in both our base case and our accelerated transition case across a host of metals and bulk commodities. And one thing I'd point out is that this is a view to 2030. So we're not even talking long-term and through the energy transition, but what's happening now, what's happening in this current investment horizon, the next sort of 8 years in terms of meeting demand growth that we see coming through in both base and accelerated cases. The point to make is that even under our base case, we don't have enough committed supply right now. So both greenfields and brownfields, let alone the supply that's needed to meet an accelerated case to 2030, not longer term. For battery materials, you can see that this gap increases substantially as you accelerate towards the pathway to net zero. So 64% of new lithium supply required by 2030 is from projects that currently don't have the green light for development, and that's a real challenge. And it's a similar picture for the likes of cobalt, rare earths, nickel, and copper, where you're looking at 30% of supply required now or in this current investment horizon doesn't have a green light or a feasibility study attached to its development. So clearly a huge challenge for the industry, and one that represents a big opportunity in terms of investment as well, not only for the mining industry, but for providers of capital. And so it's worth looking at where has the industry come from in terms of its capital outlay. And I really like the slide because it kind of highlights the changing relationship between the mining industry and providers of capital or investors over time, how those investors have moved from a growth mindset when the industry was rebounding from 2009 post the GFC crash, peaking in around 2012 in terms of overcommitting capital spend. And of course, as you all know, the cycle turned at this point, and we started to enter into a downward trend where there was a lot of concern over global demand. That culminated in a crisis of Chinese demand around 2015 and into early 2016, and a lot of value destruction was done at that point. And so the industry has been sort of labeled as kind of careless stewards of capital because of this, excess, the boom-bust mentality there that we would see through commodity price cycles. But also, it's led to the industry changing its behaviors in the years that followed very, very starkly. And so this reluctance to invest really came about, firstly, by the need to redress its balance sheets, to repair balance sheets. So you saw a sort of 3 to 4 year window of companies taking excess cash flow as commodity prices rebounded and paying off debt. And also then the period that we've been in for the last 5 years, I'd characterize that as really as repairing the reputation of the industry to its investors. And that's led to some interesting behavior. Asset sales have been the order of the day, divestments out of non-core assets, but also divestment out of the likes of coal, thermal coal in particular. And what's followed has been an outsized cash returns to shareholders that's been fueled by these asset sales. And so that has helped the industry in terms of restoring its trust and its credibility, but it's also seen a stark change in the types of investors that are now invested in these major mining companies. So now you find it's value-based investors that make up the majority of share registers versus arguably early on in the cycle where there was a growth investor bias towards those registers. And that is very difficult to change for the industry because these investors are demanding cash returns that carry on in perpetuity. When you look ahead into this next phase, which is kind of this transition indecision phase that I've labeled here, you are looking at around $400 billion that's required to build the energy transition to 2030. And so, as Michael highlighted, it takes almost heroic decisions from CEOs to commit to this kind of capital when you've got the history behind you and when you're sitting with a shareholder base that are expecting dividends to continue in perpetuity. So a lot of challenges. And I'd also highlight that the market at this point is looking at the underinvestment over the last decade and going, does the mining industry actually believe its own narrative about the change in demand that's coming from the energy transition? And lastly, the challenge is really that cash returns are a big anchor to share prices after all. So changing tack a little bit and highlighting some of the challenges that we see across the industry. Now, there's obviously a myriad of key challenges facing miners, and firstly, the macro picture, as we've spoken about on the previous panel, has decidedly worsened. Inflation is adding to on-site costs in the sense of imported inflation, but obviously has an FX offset to that. And it's also increasing the cost of financing, debt financing in particular, to some of these projects. I would also highlight that capital intensity needs to factor in carbon costs these days. It also needs to factor in carbon abatement strategies. And so the actual cost of building new projects is going to increase over time as well. Global growth is obviously slowing as rates are rising across the globe. And China is facing its own domestic issues in terms of its property sector, which faced a liquidity squeeze earlier in the year, and most recently a buyer's revolt. And we don't think that traditional stimulus in China is going to have the same impact that it did in the past in terms of getting the economy going and bailing out the global economy. So it remains also challenging to access markets for miners. I'd argue that the likes of Toronto and Australia are the most friendly towards new mining applications, and those markets really understand the issues that face junior miners a lot more than any others. So the likes of ESG and geopolitical risk are really not known by your generalist investors in any other jurisdictions. Previous panel also mentioned vertical integration, so I won't dwell on this for too long, but just to highlight that China is way ahead of the West in terms of its investment. It tends to invest right up and down the value chain, and as Michael highlighted, spending large amounts of capital. I think it was 30 billion you mentioned in Africa, and 30 billion committed in Indonesia as well, and that's all in projects that integrate right up the value chain. Western markets really don't like to do this. They tend to segmentize each stage with different risk profiles of investors, different costs of capital that are appropriate to those different stages. So that's a challenge in terms of building out a fully integrated supply chain in the West. And then there's the added risk of geopolitical uncertainty. And of course, we've seen that heightened by what's happened from Russia's war in the Ukraine. That's had a profound impact on commodity markets. You've seen coal prices reach stratospheric levels. And in many cases, there's a concern that the current energy crisis is really overshadowing the energy transition that's to come. We spoke a bit in the panel as well, stole a lot of my thunder, thank you guys, about future supply and where it's going to come from. And just to highlight that new supply for metals production that feeds into the energy transition is going to come from higher ESG risk countries. There's few mining jurisdictions that have low ESG risk profiles, and investors in the sector tend to be risk averse. So the mining industry needs to effectively manage this risk to attract investment, and part of that is really moving towards a stakeholder model. And that stakeholder model then feeds into it not only shareholders but local communities and other social challenges as well as environmental challenges that exist. So better balanced distribution of capex from a mining, of returns rather, from a mining project over its life cycle. And then investors really need to realize that this dogma of targeting only low-risk jurisdictions, stable jurisdictions, it's not going to enable the energy transition. A certain level of risk is going to have to be taken on board to enable new supply to come to market. Another critical issue is timing, and not just for mining projects, but also for right across the value chain. And so if you have a look at EVs, for example, you're taking at least 3 to 4 years to hit design capacity. Battery and cathode plants, so you're taking anywhere from 2 to 9 years to hit design capacity. And then mining projects, as this audience will probably know well, you're taking anywhere from 4 to 9 years just to hit first production, and then a further 1 to 3 years to ramp up from there. Copper, I'd highlight here, taking in excess, and this is on average over all the projects that we've covered, copper takes in excess of 9 years to hit first production. Another key challenge is really the cost of carbon. And as governments seek to really hit and honor their climate pledges, they're going to follow a carrot and a stick approach. The carrot is obviously incentivizing behavior, subsidizing solar panels on people's roofs, the adoption of EVs, whereas the stick approach is really looking at carbon taxes and cross-border adjustment mechanisms. So this chart shows a sensitivity analysis at the 90th percentile under various carbon cost profiles. And you'll see the one that I'd like to highlight is really the green one, which is our assumption for what's needed from a carbon cost, or global carbon cost, to enable a rapid or an accelerated transformation to take place. So you can see it has a huge impact on marginal cost, which obviously has corresponding impacts on where prices are likely to go in these industries to offset that. So you can see for aluminium as an example, we're looking at a 118% increase at the marginal cost, under $150 per ton carbon cost. It's huge in steel at 54%, met coal, nickel and lithium, all marked impact at the marginal cost in those industries. And lastly, just to leave you with a sense for really what's required in order to actually achieve an accelerated transition. So firstly, it's a global recognition that really what we're facing now is the challenge of our generation. All parts of the economy need to work together towards a positive long-term outcome. Governments have a role to play in terms of policy and incentives, but also, most critically, in terms of providing stable platforms for investment to take place, particularly on the metals and mining side, where we've seen policy changes almost rapidly across South America through to Africa and even indeed in Asia, that we've seen policies changing rapidly. That does not promote a stable environment for capital to flow. Capital has a role to play in terms of the cost and availability of funding, and I think that can enable positive outcomes to build the energy transition. Mining obviously needs to move to that stakeholder model that I mentioned, display ongoing capital discipline, but also start to take some really bold decisions on investing at this point in the cycle. And then partner on decarbonization for greater impacts for on-the-site abatement initiatives. Service industries, and here we're thinking about really de-risking the investment pipeline, building renewable power and on-site carbon abatement. And then, of course, the consumer has a huge role to play in terms of better standards for everyday products and really pushing forward that green premier. So all in all, it's a global collaboration effort that's needed. There's no silver bullet to the questions that we're facing. And it's going to require the likes of everyone, starting with an audience like yourselves, to take on board the message and really to push that out into the wider world. So thank you all for your time. It's been a pleasure giving the presentation, and I'm more than happy to take a few questions if there are any. Yeah.
There's a lot of these metals that go into the construction industry. And we all know that the China property sector, the building sector has, come off quite significantly. How much of that has been taken into your forecasts on these metals, especially the ones that are very reliant on construction demand?
Yeah, sure. Thanks. Great question. The answer is that we do have a fairly bearish view on the China property sector embedded in our base case. So that sets the sort of floor for its impact. But the demand growth that you see coming through from the likes of the grid build-out, from EVs, from energy storage, from solar and wind renewables build-out on a global scale under an accelerated case far than makes up for the declines that we're seeing in demand in China, especially in its property sector. And of course, the property sector really that's looking at intensive steel demand that goes into there. Copper as well has a big impact, but less of an impact on your battery raw materials.
So for the battery guys, that's quite obvious, like the lithium guys,
yeah.
That's obvious. But what about copper, graphite, iron ore? Okay, I understand that.
Yeah.
But, your coppers and your graphites, your manganese, all these have very high dependence on the construction sector. I think probably the construction building sector supplies about demands about 80%, 90% of these materials. So if that whole sector drops, you're talking about halving of that demand possibly easily. Is that still not sufficient?
No, look, no, and it's a good point, but I would argue that, right, we're capturing a pretty bearish profile as it stands now in our base case in terms of demand for copper in construction.
What's your China construction forecast like going forward?
Yeah,
0 to -2 or 0 to +2?
I mean, I'd have to get back to you on the exact specifics of that. I don't have the numbers to hand, but I mean, we can catch up after this presentation. But yeah, I mean, the point is that, look, we are fairly bearish on the sector. It's incorporated in our copper demand outlook, and I think what this presentation has showed is that the other sectors that are growing rapidly under an accelerated case for copper have a huge impact that even offsets the likes of a slowing in China property. Anyone else?